Let's go ahead and get started today. Good afternoon, everyone, and thank you for joining us today to learn more about investment real estate in Western Washington. My colleague and I have an interesting discussion planned for us today. We plan to speak to the key investment drivers of our local market here on the western side of the Cascade Mountains. And we hope to share our interpretation of the market data backed up with our insights and outlooks based upon our experience. The goal here today is really to leave you with some information and insight that you can apply to your own investment strategies. So let's officially kick this off with some quick introductions. In the name of efficiency, I'm going to go ahead and start. My name is Scott Greavy, and I head the real estate advisory here at Brighton Jones. My team supports our clients with real estate investment strategies, whether that involves the optimization of currently held real estate assets or acquisition and transition strategies into new paths. We are focused on understanding our clients' unique real estate goals. So we believe every scenario is a new opportunity, and there's not a one-size-fits-all approach to investing in real estate. We love to account for the unique details of each asset and provide customized recommendations so that our clients are well informed when making the rather large financial decisions associated with investing in real estate. Enough about me. I'd like to give our special guest speaker a chance to introduce herself and her company. Candace, you have the floor.
Thank you. So my name is Candace Chevalier. I am a principal at Lee & Associates Commercial Real Estate Services, and I've been selling apartment buildings in the Seattle market for about 20 years. I've worked at large corporate brokerage firms, small local boutique firms, and I've even run my own firm for a number of years. And I, at Lee & Associates, that is a national brokerage with over 1,000 brokers nationwide, including 65 offices around the country. Locally, we have about 54 brokers working in all of the commercial real estate food groups, multifamily, office, industrial, retail, land. We have offices in Seattle, Bellevue, Tacoma, and Queen Anne, where my team is based. And like Scott, we love working with owners and looking at the value of their apartment buildings, helping them decide what kind of strategy would meet their investment objectives, and then really creating a customized plan to realize those investment goals. And after 20 years in the industry, it runs the gamut, that's for sure.
Thank you, Candace. Brighton Jones definitely appreciates our relationship with Lee & Associates, and I'm really excited to be presenting with you today. Let's talk a little bit about our agenda. So our goal today is really to orient you with the past, current, and future potential states of Western Washington's investment real estate market. We're going to focus on the specific market area comprised of King, Pierce, and Snohomish counties west of the Cascade Mountains. You'll hear about data, metrics, and analytics specific to this, what we call Tri-County area. So we'll start with a look back into the recent history and reflect on where the market's been, addressing trends from 2019 through 2023. We'll pick up then with the current state of the market today and really look at the key drivers of value. We'll then discuss our thoughts on where things are going to be over the next 3 years and what this market might look like at that point in time. Hope is to reflect some of our best thinking and provide additional outlook for you to consider within your own investment strategies and approaches. If we have time, we're going to wrap up with a look at the key legislative drivers coming out of the state level down in Olympia that affect real estate investment here within our region. Before we get going, let me pause for some quick housekeeping items. Please do feel free to submit questions using the question button at the bottom of your webinar screen. We'll be sure to pause throughout our conversation today and do our best to answer questions that do come through. If we don't get to everything, we'll be sure to follow up with you. You can also always reach out to us directly. Both Candace and myself will have our contact information on the last slide of this presentation. So without further delay, let's start our discussion. Candace, will you frame up the recent history starting back in 2019 that brought us to where we are today?
You bet. So today I am going to focus primarily on multifamily apartment buildings, just to kind of set the stage. And this slide basically shows sale metrics in the Tri-County area, which is King, Snohomish, and Pierce. And the bar graph basically shows the volume of sales over the last 4 years. The table underneath that shows volume totals as well as the number of sales in a given year and county, just to sort of orient you. So in dark blue, you can see how much of the total volume occurred for King County, in terms of that being a dense market with a lot of buildings. That is certainly the driver of a lot of the volume numbers. So that's in dark blue. And then in turquoise, that is for Snohomish, and gray is Pierce. So it just gives you a feel for in each of the counties how much of the volume attributes to the total. And then looking back, we'll start with 2019, which was an interesting year in that there was a huge amount of volume, mostly driven by a change in the structure of the real estate excise tax, the REIT tax, which went into effect January 1, 2020. And what that did was essentially change from a flat tax to a graduated tax based on the size of the transaction. And so there was a very significant initiative amongst owners to, if they had owned for a long period of time, to sell ahead of that tax. And so interestingly, there was a tax, a bill at the legislative session that just closed on Sunday, discussing how to further increase that tax. It did not pass, so we'll talk more about that later. But so that's 2019. 2020, obviously, we was especially sluggish from COVID. And as I think about it, many an investment thesis was turned upside down. I remember speaking with owners and said, I put a lot of things in my model, but I did not put a global pandemic in my model. And if you remember, we also had some BLM protests. We had some fires at that time. Like, it was just a really interesting time in the sort of Seattle collective history. And so from that standpoint, 2020 was dropped significantly in the amount of volume. And I remember sitting on a panel with Scott in March of that year and remember thinking, well, investment prospects look pretty good, unless this newly developing coronavirus that we're kind of hearing more about turns out to be a black swan event. And sure enough, that's exactly what happened. So that was 2020. We all remember that, not as fondly. And then interestingly, in 2021, volumes jumped right back up. And really that was due to pent up demand. It was actually really hard to even try to sell an apartment building in 20 because, even just inspecting units and getting out in the field and some of those things were significantly locked down. In 2021, we saw starting to see the removal of eviction bans. There was a rent increase cap, if you remember. So that was a year where rental demand went off the charts and interest rates were still really low, about 3.5% at that time. So that was probably a high watermark for our market. And so that was a banner year and a high degree of confidence of just sort of, okay, that's behind us, we're moving on. Then in 2022, two elements started to cool investment demand. One was in late February 2022, Russia invaded Ukraine, and that it created sort of a global conversation around stability, geopolitical stability. And then in mid-March, the Fed then began raising interest rates in earnest. And so that really put kind of a governor on that speed of investment. And that was the point, but but you can see the impact of that. So in 2022, at year end, sales volume had dropped about 40% from 2021. And even now those rate increases are a major headwind. So all that kind of leads to the question, how are values holding up?
Yeah, Candace, great points. Before we leave the slide, I just want to an interesting question has come in about just the rapid drop in 2020. Usually, in my real estate investing career, you don't see changes this dramatic, this quickly, the down, the up. Was there opportunity to be taken advantage of in 2020, or were the markets just anticipating that rebound in 21 to the point where it was too quick of a window to really take advantage of, and the metrics just responded?
Yeah, I mean, I think that's a good question. This is really, looking at volume, just how many deals got done. And I think the reason that it was so suppressed in 2020 was almost more mechanical. Like I mentioned, there was the investors knew that there was a change, but there was very little clarity around, okay, well, what is the new market before and after COVID? And I do think there was a little bit of an opportunity where I remember having the conversation with an investor because I'm an urbanist, and I'm very pro, downtown and in-city markets like Seattle, where the economic base is, the jobs are. And I remember having a conversation because at that time, there was a new sentiment that maybe it was all about the suburbs, right? Maybe living downtown when everything's closed and there's tents on the street and the whole thing, maybe the thesis is wrong. Maybe it's all about the suburbs. And I think we saw that to an extent, and I think we're seeing the reverse of that beginning. It's still very much in recovery mode, but I think we're seeing a reverse of that. All right, so let's go back to values and looking at cap rates. Cap rates essentially are an investor's way of evaluating how much they're willing to pay for a particular income stream, and it's a good metric to really understand how investors are pricing risk into their decisions. So this graph shows basically cap rate trending from 2019 to 2022 by county. And so generally speaking, we were expecting over the last few years to see cap rates increasing with that increased level perception of risk. But as I mentioned, in 2021, very strong metrics on the rental market side, it coupled with low interest rates, allowed investors to pay lower prices or pay higher prices. And then now with the introduction of interest rates moving, we're seeing a little bit of an inflection point in the first half of 2022, where now we're starting to see cap rates trend upwards. So from that standpoint, I'll just define, sometimes people think of a cap rate as, well, what do I want as an investor? Do I want a higher or low cap rate? It depends on your perspective. If you are selling a property, you want as low of a cap rate as possible. If you're buying, you want as high of a cap rate as possible. Just thought I'd mention that. So, so moving on to the valuation and sale metrics, this slide essentially starts to show you that volume a little bit in a different view in orange. And over the past few years for the Seattle MSA, which includes, again, that Tri-County area. MSA is the statistical area, market statistical area. So the blue line here starts to layer on price per unit. And you can see that slight dip that we saw actually when we were looking at the timing of an inflection point for cap rates in 2022, where price per unit now starts to trend downwards. And this is probably, that was showing you kind of the height of the market, demand for the market, and now that's coming down. So this is kind of the right, what's happening kind of last year, and aligns with that cap rate activity, and takes us to a conversation about rental rates. So this graph starts to just talk about what's been happening with rental rates. And part of demand for investment property centers around, well, what's happening with rents, right? There's the current rents in a building, and there's where it could be if it were running on all cylinders and maximized for market rent. So our region has benefited from the strong rental market over the last 6 years, with rents increasing steadily, with the exception, of course, of the drop during the height of the pandemic. You can see that in 2020, where rents actually fell. And then as we saw vaccines becoming available, the economy going full steam ahead, and renters really reconfiguring for hybrid work, we saw huge demand for rents and the ability to kind of turn rents over. Also, the rent increase cap came off. And so investors could actually put out rent increases, or and renters could actually move. And so that fueled quite a lot of rent growth during that year, and also through kind of early 2022. So that's where we've been.
Great, thank you, Candace.
Yeah.
Let's take a quick moment to kind of recap, where we've been before we look at where we are now, and kind of highlight the recent history that Candace was talking about. So 2021 proved to be a year for the record books. You really couldn't go wrong with investment real estate. And looking back, this year signified really the peak of our local market. 2022 started steady, but led to that inflection point that Candace was discussing, both in valuation and velocity across our local market here in Western Washington. The key driver affecting that change being the sudden and rather dramatic march upward in interest rates on both a regional and national level, which is really no surprise at this point in time. Rent growth, one of the more significant, important drivers to a successful real estate investment, outperformed expectations and really led to a significant compression in cap rates across most all asset classes in Western Washington and up and down both coastlines for that matter. So interesting where we've been. We're going to talk about where we're going here in a minute, but there's a couple more questions that have come in that I want to address. Here's one. What was driving the higher volatility in Snohomish County versus a more steady trend in King and Pierce counties from 2019 through today? So I think that's kind of harkening back to that cap rate slide where we saw the more of the up and down on Snohomish versus the other two counties. An interesting observation.
Yeah, and one of the things I mentioned early on is that, and it's interesting, I'm looking at the Q&A and someone just answered the question, and he's pretty close. So basically, Seattle is a larger market, and so with more transactions, it tends to kind of even out if are outliers, either low or high. In some cases, we see the sale of a lot of larger apartment buildings or older apartment buildings, and that can affect the metrics. And so in the case of Snohomish, it's a smaller market. There were not that many transactions. And so any ones that occurred kind of really dictated exactly where the averages were. So I tend to like to have more data points rather than less, because I feel like that gives us more certainty around what the trend actually is versus outliers.
Yeah, great. Okay, let's transition back to our story. Candace, do you want to continue, kind of bring us up to the current state of the market and reflect on where we are right now?
You bet. So here we've got a slide on rental analysis, and it's showing market rent per unit and rent growth. And I think there was a question just about, what unit type. This is across all unit types. So, it's true that it might be a different story for, call it a CDU, open one, small kind of efficiency unit versus maybe a two bedroom, 2-bath, 3-bedroom units. So really diving in, like if we're looking at the value of a building as an example, we're not looking at summary level data. We're going into what is on the market in that space at a particular point in time for that unit type. So in terms of kind of where we are right now, we're expecting to see a wave of new units that will increase vacancy through the course of this year. And that has a lot to do with a large number of developments that, quite frankly, were slowed down by COVID, and the delivery of them we've had kind of this long delivery cycle of units that was expected to hit within a couple of years, and it sort of spread over time. And so we're, right now we're just seeing a lot of new and expensive units coming online. And so we do expect to see measured rent growth going forward, but from that standpoint, we also tend to see seasonality in our market. So you can see how the green line effective rent per unit sort of jogs up and down. That has a lot to do with our market, and that the time to rent is actually right now. Sort of that April to October time period is probably the best time to be offering your unit to the market. And in December, January, people don't want to be out looking at apartments when it's raining sideways. And so we tend to see that actually showing up in the data, that seasonality. So we're expecting to see continued value contraction over the course of this year for rents, and from that standpoint, a slowing of new deliveries will start to help with that. And then this slide basically starts to dive into vacancy rates and kind of where things are right now. This is as of this spring. And you can see in downtown, that's the market with the highest vacancy. That's also the market that has the most new product coming online. And we still have some social issues that are still being rectified, and we're recovering from the pandemic that occurred. And so that's taking some time. And then you can see some of the like South Seattle markets are pretty tight. You can also see, Bellevue really, very healthy. Anything under, call it 5%, there's usually room for rent growth in that market. And if it's over 5%, probably we're going to see some softness in rents. And so from that standpoint, we can also, in this case, this is Snohomish County, and you can see a similar dynamic here, pretty close, tracking pretty close, a little bit below, a little bit above that 5% equilibrium number for vacancy. And then rents, I mean, you can see if you looked at the previous slide and now this one, it's hard to find something under for a 2-bedroom under $2,000. And, if you go north and south, you see that affordability starting to shine through.
Great numbers. Very interesting. Interesting question came across before I go into recap kind of where we are right now. I just wanted to throw this one out there. I think we can continue to answer this as the webinar progresses on, but are there any comments on the ubiquitous conversion of office buildings into residential? I knew that was coming.
That's a fun question.
Yeah.
Well, I can tell you that just yesterday morning, I was downtown in a building on 3rd Avenue, and we were all scratching our head trying to think, what if this could be multifamily? And there are lots of factors to consider. And I think the biggest one is, how was that building constructed, and are there the windows on the sides? Are there, enough light coming in? Because, if we take sort of that concrete block 50s construction, those buildings don't convert very well. Whereas if it's more of a turn of the century with kind of those big, floor to ceiling, kind of more of that kind of window style, it's possible. The challenge is construction costs are high just for anything. And in particular, retrofitting and converting is very expensive. So figuring out a way to make that work. I know the city is holding meetings and offering, a forum to try and figure out the answer to that question.
I'll just add, reflect what you're seeing. We are working with some clients on that exact question right now with some of their real estate holdings. And it is a difficult equation to make work. Office buildings were built with a different design in mind. And when you think about coring and utilities and infrastructure within an office building, it's a lot different than a residential. So making that transition is sometimes very cost prohibitive. Some sector of office buildings, this is going to be a perfect fit for, but generally speaking, it's a lot more difficult and expensive right now. I do know that there's rumblings about exploring some public support to move that forward. So we'll see if that gains any traction as well. So yeah, great question. More to come on that one, I think.
Yeah.
So we can make sure we cover everything today. Let me keep going and just recap kind of our best thinking and evidence of today's market. We've seen moderation in all key investment drivers really across the board. It's not surprising, given the tangible rise in the cost of capital due to the interest rates. Locally, we're keeping, especially myself, keeping a close eye on the employment picture. We're going to talk more about this as we move forward, but we're seeing a much weighted impact on the local economy as multiple high-paying technology companies retrench both their employee count and their forward-looking hiring strategies. This does have a pretty direct impact on our local real estate market that we're going to talk more about. But the Seattle area can no longer count on that massive annual influx of highly paid tech workers that really became the norm before our slowdown. So no more bringing that 10,000 plus workers into the region from out of state every year, which really bolstered our local real estate market. And then finally, we're seeing that ratio-driven correction in the lending environment, driven primarily by increased rates pushing LTVs lower. So this requires higher amounts of equity, which does put downward pressure on overall returns and IRRs within an investment property. So quick recap as to kind of where we are now. Another interesting direct question came in regarding some of the interest rate discussion we've been having in the financing piece of it. And is it easier or harder to qualify for investment money today for real estate? Any thoughts on that, Candace?
So I would say that lenders always like someone who has a track record. And I would also say that if you have a relationship with the bank or can create a relationship with the bank, you will get premium pricing. I see that time and again. And depending on if we're talking about 1 to 4 unit investment properties or 5 and 5+ unit investment properties, there's a delineation from a financing standpoint. 1 to 4 units, generally based on the borrower. And so from that standpoint, they're very much looking at can this person cover the debt service on this building, if all else fails. And that's the main focus. For 5 and up, the building begins to step into the center of the stage as can this building support the debt service, and not only support it, but exceed it by, call it 20%, 25% in order to ensure that that the debt service is paid.
Yeah, no, great point. And we're going to talk a little bit more about DSCR, debt service coverage ratio, here in a future slide, because it's definitely impacting the velocity of our investment market today. I've got to answer this question. You touched on it a few slides earlier, and it's come through. So is it true that commercial located in premier Seattle or Western Washington neighborhoods is somewhat insulated?
So
office, whether it be retail.
Yep. So I think that we have to look at each of the product types slightly in a slightly different lens. I typically think of markets as micro markets, right? I don't think of Seattle MSA. I think of, here's this building and what are the drivers for that building, whether it be close to a coffee shop, close to transit, close to some sort of employment base. Those are the things that I think drive that individual investment versus just kind of, it's almost like listening to a national real estate forecast. There's all sorts of different metrics. Real estate is a local business. And so from that standpoint, I think we have, amazing multinational businesses that are located here. Even with tech hiring slowing, we have expectations that the population itself is going to continue to rise. And so we have a lot going for us in this market that we can touch on. And we can always go into more detail on that land constrained market, that center of Seattle, being close to employment, even with hybrid work, is important.
Yeah, no, great point. And to your point, one of my non-negotiables when I invest in real estate is I have to be walking distance from a coffee shop. That makes good real estate to me.
It does.
Okay, let's transition back to the third and last part of our story. Candace, what are we seeing for our local Western Washington market in the next few years? So let's pull out our crystal ball and go forward.
Okay, well, I'm not going to say anything about black swans because I don't want to go through that again. So looking at economic demand, I think this is a really interesting slide put together from a close colleague of mine, and he, essentially looks at where are the jobs being developed. We kind of talked about what's that insulated story, and where are the jobs being developed, and then where is the demand going to be for rentals. And so this is kind of split out by market, and then what it's showing is the percentage of that rental demand, where it falls from a location standpoint. So interestingly, again, we talked about maybe there's not this urban core, maybe it's a flight to the suburbs. What we've seen in the data is actually that Seattle is capturing about 60% of the rental demand and is being consistent in capturing that 60%. So when people move here, young people moving from other states and what have you, they want to be close to entertainment, to nightlife, to employment as well. And so what we see as we go through from 2022, starting to move forward now, we saw, East Side definitely scooped up a decent amount of that market in 2022, and you can see it starting to wane a bit in 23 and 24. Some of this may be related to the demand that that tenants be back in office, right? We've had in fact, Redfin just this morning made a proclamation that they want people back in office. And Amazon has made that same kind of stake in the ground 3 days a week. So, it's calling into question job security and the amount of hybrid work that business will be able to support. And so I think that ultimately is going to drive demand to in-city. And if you see where it's pulling from, East Side is actually losing a little bit to South End and Snohomish. So that's kind of an interesting factor as well.
Yeah.
All right, so now I know that there was a question earlier about rental, kind of projected rents, and this is really where the crystal ball is. And what I would say is these percentages, are just that market in general. And I see investors all the time that can better the results or don't measure up to where we think that they should be. And so that's a whole nother conversation. But for 2023, we are seeing a slowdown, but it's still kind of in that 5% range for rent growth expected this year. And we're expecting that to taper down 2024 and 2025. So, in a typical model, when I'm looking at an investment real estate, I like to plug in 3%. That's conservative, right? It's been a little bit better than that over the course of this year, and then softening to kind of in that 4% range for next year and 3% range for the year after that. Again, I think that a safe bet is 3%, and if you can do better, great, but buy the real estate based on a conservative estimate for rent growth.
Hey, I don't see any minuses in front of those numbers. That's fantastic.
And that's just it. A lot of times you'll see in the paper, you'll see, rents are going, we're losing growth. Well, losing growth isn't negative. It's you're losing momentum and you're not growing as strong of a rate, but it's still growth. So I think that's an interesting thing to keep in mind when you're reading the headlines.
Yeah, absolutely.
Okay, so this one kind of brings a few things together, and looking at rental supply, demand, and vacancy trends. So what we're trying to identify in this slide is really where do we think that is the optimum spot for rents to really start to take off again and go from that 3% kind of conservative estimate back up to 3 and I should say 5 and 7%. So in this slide, absorption is in orange. That's essentially demand. How many units are being rented, absorbed. In blue, you see the new unit deliveries, and that's essentially supply, all the new units coming online. You can see, in 2022, we had all the supply and demand kind of down a bit. And so what we're expecting to see is rental demand and rental rates begin to intensify in that kind of 2025 range, see where it sort of flips and the absorption, the orange bars go above the deliveries. That's basically supply and demand. We've got more demand than supply at that point. So that's sort of where we're thinking things start to just stabilize and start getting better.
Oh, great. Yeah, that's very interesting. We'll talk a little bit more about that inflection point here in the next slide or two, but just wanted to take a moment, take a little detour, and talk about the consistent message that we've had today, which is interest rates. So the topic of conversation on this slide is interest rate behavior. And it really is making a direct impact on both the value and performance of investment real estate here in our region. So let's dive a little bit deeper here into the mechanics of how these impacts have really manifested themselves both on our current and near future valuations. So you're gonna have to bear with me. You're gonna get a little bit under the hood here, but really my goal is to orient you with how interest rates really do drive changes in value. So first thing, let's set a baseline, and we've really seen a substantial 3.2% increase to the cost of capital over the past 14 to 16 months. And really, it doesn't seem like a big number, but that is significant. So between August and November of last year, rates hit 7.2%. And ultimately, that's not something we've seen in over 10 years. Since then, rates have really leveled off and come down to 6.5%. Today I looked at it as 6.4%. However, the damage had been done and change was really catalyzed in the lending environment. So this is going to get a little bit technical, but the increased cost of capital led to more dollars needed to meet debt coverage requirements for lenders to really properly hedge their risk. So debt service coverage, or DSCR, as we like to call it in the industry, is a key component of underwriting, and ultimately one of the most important metrics when you're analyzing investment real estate to purchase. So if additional revenue can't be had by raising rents or reducing expenses, there's really only one outlet, and that's to take less loan and bring more equity into the investment. So a lot of fancy industry jargon. What am I trying to say here? Well, what I'm trying to say is this trend of lower leverage ratios means that investors need to bring more of their own dollars into deals to ensure that debt coverage pencils properly for loan underwriters. And that's ultimately not something an investor really wants to do. Less leverage overall means lower returns in IRRs, and it really looks to be a bit of a double whammy, bringing more money in for less return. And that's not favorable to real estate investors. So these lower returns and this elusive positive leverage that makes real estate deals shine creates a response, and that means lower values and lower prices. And that's not something an investor, especially an investor that's trying to sell their property, wants to hear. However, a lot of negative talk around interest rates. We all know that there is a silver lining here, and that's in all this interest rate talk, and that's that rates don't stay the same forever. So with values down, there are longer term opportunities that may become and are becoming available. So my philosophy here is don't pass by a good opportunity, because eventually rates will soften and you'll be able to refinance in the future. It's just a matter of intelligently and smartly bridging that gap. So a little bit on interest rates and how the under the hood mechanics work, driving those leverage ratios lower and ultimately impacting value. Candace, do you want to walk us through some sensitivity around these interest rates, vacancy, and
Sure.
rent rates?
Yeah, and I think that this is kind of a little bit of a case study, if you will. It's a theoretical kind of 20-unit apartment building worth about, call it $6.5 million. And what we did was we went through and looked at the sensitivity of different elements of the building, right? So there's market rents. We've talked a lot about where are rents, what can we do with rents? In some cases, market rent is what it is, but often, like I said, there's a discrepancy between where the building's operating and where market rent is. And so if it's a building that's been owned forever, long-term owner, tons of equity, we see all the time that there's a ton of rent upside on a value add on these buildings. And so I thought some kind of rules of thumb would be useful here. So we modeled it out and looked at for, market rent, we talked about percentage points and things like that. For every 1% of rent growth, that equates to about 1.43% of an increase in value on the building. So we're increasing the income, increasing the value of the property. That translates to about $100,000 per 1%. So that's kind of gives you an idea of how you might move an existing investment that you're paying whatever the price is today for, but how you could actually improve the value even if the market's down. Another element of it would be vacancy rates. So vacancy rates, there's usually a market vacancy rate, but then there's what's the vacancy rate at a property. So for rule of thumb, 50 basis point increase in vacancy equates to about 75 basis points loss in value. So about $50,000 loss if we go from 5% vacancy to 5.5% vacancy. So quick turnovers, right? Not having a ton of time on the market, really great leasing team to shorten the amount of time and decrease your vacancy rate on your property. Those are ways to, instead of having a loss, those are ways to have a gain. And then interest rates, we were just talking all about interest rates. So for every 50 basis point increase in interest rates, that's a loss of about 4% in value, which equates to, call it $200,000 to $275,000 in value for, again, this 20-unit apartment building. That's one of the reasons why we haven't been able to keep up with that interest rate growth, because we would have to be raising our rents 4% just to stay even at the same returns. Because of that larger debt service. And so initially we were able to kind of keep up with that, because in 2021, we were able to raise rents. If there was still rent upside in 22 as rates started to go up, initially we could kind of keep up with it. But then at one point we sort of fell off the back of the wagon, right? And so that's really just giving you a picture of the impact of interest rates and how it ultimately has to affect value.
This is a fascinating slide to me in the sense that, 50 basis points is a 4% decreased value. If we do the math, based upon what we've seen with our interest rate increases since 2022, I don't think we've seen a full retrenchment in that impact on values yet. And that was one of the things that's actually surprised me, is how slowly values responded to the rapid increase in rates. And I still think there might be a little bit of catching up to do.
Mm-hmm. Yeah.
All right. Fantastic. So let me just recap a little bit more about where we're going and talk to the key components of our future outlook. Again, these are opinions based upon what we're seeing historically and the behavior of the key drivers that Candace was going through in some of those technical slides. So we've definitely seen rent growth slowing, but we don't see red yet. Rather, we do expect this important measure to really return to more longer term, more reasonable historic norms. And that's really a good thing. Actually, it's a great thing, because it portrays as close to a soft landing as we can expect with real estate here in Western Washington. Of course, this does not reflect all asset classes or specific locations. We've actually seen a tip to the negative within Seattle, but outlying areas generally are holding favorable. And then if you look at office as an asset class itself, that's behaving significantly differently than, of course, multifamily, but that would be a whole nother discussion for another day. I think, as Candace mentioned in one of her slides, the new supply is going to moderate in early 2025, and it's going to take some of the competitive pressure off rental rates to the benefit of real estate values here locally. And then we've got some questions on this, but I do want to highlight this point. The local employment trends are really going to be a key driver. We anticipate continued difficulties through at least the first half of 2024. However, keep in mind, longer term, Seattle and Western Washington show strong, sustained employment growth in technology and the higher paying jobs as compared to other markets. I've always believed that real estate value and wealth is really created over a minimum 5-year, more preferably 8 to 10 plus year period. So that philosophy and that approach to this market really does bode well longer term for investing in this region. So and then back to our interest rate story, which is tough to get off of because it is such an impactful thing. The forward looking trends for interest rates will be an important driver to the unfolding story around real estate here in Western Washington. If we had to pull out our crystal ball, we see, rates peaking toward the end of this year with a potential reversal starting, sometime in the first half of 24. This should ease some of the pressures affecting values, but there's a main wild card there that the reason for those easing interest rates is most likely a retrenchment in the economy and potentially a tip into a recession. So how deep and how broad that is, we don't know, but it's definitely a change from where we are and where we've been over the recent year and a half. So that's a quick recap on where we think we're going. There's an interesting question I'll pause for here, Candace. How does the tech layoff cycle figure into rent growth in your forecast?
Well, it is showing that our rent growth is kind of waning, right? And the layoffs are happening now. It's not. I mean, interestingly, like we've gotten very used to your stock portfolio as an example. You have instant feedback, and it takes time for the market to speed up and slow down, for a real estate market to speed up or slow down. So while we still have that 5%, remember every day we're having new units delivered to the market that are adding supply. And so the tech layoffs, again, the thing that I've also heard about the tech layoffs is it's a reality, but those skill sets are still very much in high demand. And so they are actually finding new employment, whether it's locally or nationally. That tech worker, the demand for that skill set is still there, but there's just been kind of rejiggering of which companies overhired, underhired, and kind of a rebalancing.
Yeah, agreed. So let's see, we've got about 10 minutes, which gives us a little bit of time to talk to some of the legislative changes coming out of Olympia that for those of you that live in Western Washington and invest in real estate here, are driving key impacts to where things are going. So Candace, you are definitely a resident expert on this. Would you mind guiding us through?
Sure. Yep. And I'll kind of stay at a high level. I have sort of individual bills and whether they passed or failed, but I'll kind of just speak broadly in that in general, we had, and actually that number one did not pass, which is a good thing. That actually it was in danger of passing over the weekend. The legislative session ended on Sunday night. And I actually reached out to the lobbyists because there's been no news about it. There was a lot of news about not wanting it from the industry, but not once it actually didn't pass, no news about that it didn't pass. So that one did not move forward and would have created a new tier for the state real estate excise tax. For any sales over 5 million would have had a 4% tax on that tranche. So it was a big deal. And that did not pass. And that's just it. We have had for 2023 a pretty successful legislative session. When we think of investment real estate, some of the benefits, the things that did pass that is good is looking at passing the ability to speed up the delivery of housing. That's good for kind of the affordability conversation in our region. Increase housing density, speed up permitting, reduce construction backlogs. Those are some of the bills that passed that are moving forward. And then what didn't pass was equally creates a headwind in investment real estate, and that's various forms of rent control. So there were a lot of proposals, but nothing that passed in Olympia as it relates to rent control.
Right, and I'll just add just a couple point of clarity here. We'll have to get our slide corrected, but HB 1628 did not pass. So I just want to make sure we're correct on that.
Yeah.
And then this is the state level. Each municipality is going to have its own layer to law. So those of us that invest in, for example, Seattle, have a little bit more robust level of regulatory requirement than those broader at the state level. So it changes based upon where you are located and investing in as well. I just want to point that out.
Correct. Yeah.
All right. So we're going to start to wrap it up here. We've got just about 6 or 7 minutes, Candace, and this is my favorite slide. It's us providing key takeaways in summary fashion on where to go for, if you're going to be investing in local real estate here in Western Washington on a go forward basis. So Candace, you want to start us off, and then I'll kind of pepper in.
Yep, that sounds great. The first one is sort of embracing the uncertainty. And we've talked a little bit about this throughout the presentation today, that there can be market factors, but really thinking differently, embracing kind of the wave, getting creative on how to solve business and operational issues with creativity and kind of a customer service mindset. These are some of the things that you can do to affect the success of a property that you currently own, or one that you see potential in. And so embracing uncertainty is a huge part of investing in real estate, really. When it's certain, then everyone knows. I can move on to cash is king. We talked a little bit about the effect of rising rates and how these loans are resetting, creating a lot of opportunity for buyers with cash. I was working with a 1031 exchange buyer. She's intentionally not stretching for leverage, and instead she's going to have $2 million coming out of a sale in California, and she wants to place $2 million. And then she doesn't have to worry about what's going on with interest rates. Another opportunity is seller financing, and looking at options for seller financing. Maybe we can get a little bit better price for the seller, and we can get a great interest rate for the buyer. There's tax benefits on both sides for seller financing. So we love putting together transactions like that. Yeah. Being a contrarian, we talk about being able to see opportunities wherever, the market's kind of all thinking this way, and you're seeing, some kind of silver lining or some kind of opportunity over here. So we really recommend that mentality. And fish or cut bait. Sometimes, you have an investment, you've done what you're going to do with it, and it's up for the next person to do. So maybe it's a property that has land value, development value. Maybe you sell that building to a developer who has the expertise, instead of risking your own retirement for cutting your teeth on your first development deal, and maybe moving on to something that you really are good at, that is in your wheelhouse. And then playing the long game. Scott, you've talked about how, over the last few years, there's been a lot of quick gains. But real estate typically is a long-term investment. It's not a stock that you buy and sell from one day to the next. It's something that you're owning for 5, 10 years. Many of my clients, 20, 30 years, 40. And so really doing the best that you can with that asset all along the way, so that you can capitalize on opportunity when you do decide to sell.
Yeah, no, great points. I'll just add in on the middle two there, the cash is king and be a contrarian. Those two kind of mutually reinforce each other, given where we are right now in the changing environment. I believe there's going to be opportunity as the rates continue to put pressure on values. It's going to be a unique environment at some point in the not too distant future to take advantage of. So keep in mind that if you do go into a purchase with cash, you're going to have negotiating priority. And that being all cash in a piece of real estate is not a permanent thing. When rates do come back down, which inevitably at some point they will, you're going to be able to refinance out and get liquidity at that point in time. So look at it on a shorter term basis and be ready and willing to take advantage of opportunity as it presents itself here in the not too distant future. Good points.
Yeah.
Fantastic. So let me slide to our final slide. This is our contact information. We definitely like to thank everybody for joining us today, and hopefully we provided some valuable insights on where we are in Western Washington investment real estate markets, and ideally some interesting thoughts to where we might be going in the shorter term over the next 3 to 4 years. So Candace, do you have any parting thoughts for the group here today?
Sure. I saw sort of one more question that's always a fun one. You know, if I'm a seller, what should I do? If I'm a buyer, what should I do? And I'll just give you a couple thoughts. As a seller, really working on keeping your rents as close to market as possible to be able to maximize those loan dollars is absolutely critical. For many years, it was what's the price per pound, price per unit, price per square foot. That's all anyone cared about. Right now, all that matters is what is the income stream coming off that building, and what is it now, and what can it be? And so that, as an owner, you know, that's one element. The other thing is, again, seller financing. That's a great area of opportunity for to maximize value if that fits within your investment strategy. As a buyer, I would say looking for some of those financing opportunities. Maybe seller financing is an opportunity, and then that difference between where the building is running and where it could be running. You can buy off on a lower return on today's, you know, picture if you can create that business plan to exceed whatever the interest rate that you're paying. So in essence, you're going to want to have positive leverage eventually, but you may not have it on day one. So I wouldn't just discount the opportunity based on that.
Fantastic. Great advice. Sage, wise words. I love it. Everything resonates there. All right. Well, thank you everybody for your time today. I hope this was a productive lunchtime event. And if those of you that were not able to attend, I'm sure that our marketing department is going to resend out the link so you can rewatch this at your leisure. So until next time, have a great day and take care.
Thank you.